If you had put $10,000 into gold back in 2016, when it was sitting at $1,250 an ounce, right now, today, in May 2026, that investment would be worth over $37,000. No stock picking, no crypto gambles, no sleepless nights watching ticker symbols. Just gold. Now here's the question that millions of people are typing into Google right now. Is it too late to buy? Because gold has already run from $1,250 in 2016 to over $4,700 today. It hit an all-time high of $5,589 an ounce in January. It's pulled back, and right now, the price is sitting around $4,700. JP Morgan says $6,300 by end of year. Goldman Sachs says $5,400. Some analysts say the bull run is over. So who is right? And more importantly, what should you actually do with your money? That's exactly what this video is going to answer, with real numbers. Here is the situation most people find themselves in right now. Gold has been on one of the most dramatic runs in modern financial history. In 2025 alone, just last year, it rose 64%. 64%. That is not a typo. In a single year. Then it went even higher in early 2026, hitting $5,589 in January before pulling back to where it sits today. And most people watched all of that happen from the sidelines. Maybe you heard about gold and thought, I'll look into that later. Maybe you assumed it was already too expensive. Maybe you thought gold was something your grandparents cared about, not a real modern investment. And now you're sitting here in May 2026, watching it trade around $4,700 an ounce, wondering if the ship has already sailed. At the same time, everywhere you look, things feel financially uncertain. Inflation is running at 3.8% as of April 2026. That's nearly double the Fed's 2% target. Real wages, your actual purchasing power after inflation, just turned negative for the first time since 2023. The stock market is volatile. Geopolitical tensions are running hot, and the dollar has been weakening. In that environment, gold starts to look less like a relic and more like something that actually makes sense. But there's a real danger here too, and that danger is buying into hype at exactly the wrong moment, overpaying for an asset at its peak because fear and FOMO are doing the thinking instead of logic. So we are going to cut through all of it, the hype, the fear, the gold dealer marketing, and give you a clear, honest answer. Here is exactly what we are going to cover. First, we're going to explain what is actually driving gold's price right now. Not the generic safe haven explanation you hear everywhere. The specific, real reason. Second, we're going to look at the honest numbers. Gold versus stocks over the long term. What $10,000 in gold does versus $10,000 in an index fund over 5 and 10 years. Third, we're going to walk through the bull case and the bear case, and what JP Morgan, Goldman Sachs, and the World Gold Council. And fourth, we're going to give you the practical answer, but a clear framework for exactly when gold makes sense in a portfolio, how much to hold, and the best way to actually own it in 2026. By the end of this, you will know what to do. Let's go. This is not random. There are 5 specific reasons. Gold does not move randomly. Its price is driven by a very specific set of conditions. Reason 1, inflation. US inflation came in at 3.8% in April 2026, the highest reading since May 2023. Energy costs are up 17.9% year on year. When the purchasing power of cash falls, people move money into assets that hold their value. Gold has done that for thousands of years. That dynamic has not changed. Reason 2, central bank buying. This is the one most people miss. In Q1 2026 alone, central banks around the world net purchased 244 tons of gold. That is up 3% year on year. Countries like China, India, Russia, and Turkey have been systematically moving reserves away from US dollars and into gold for the past 3 years. Total gold demand in Q1 2026 reached 1,231 tons, worth a record $193 billion, up 74% in value year on year. Reason 3, a weakening dollar. Gold is priced in US dollars. When the dollar weakens, gold becomes cheaper for international buyers, which increases demand, which pushes the price up. The dollar has been structurally weakening as confidence in US fiscal policy erodes. Reason 4, geopolitical risk. The conflict in the Middle East, the disruption to the Strait of Hormuz, oil above $100 a barrel. When the world feels unstable, money flows to gold. It always has. It always will. Reason 5, the all-time high and the pullback. Gold hit $5,589 on January 28, 2026, its highest price in history. Since then, it has pulled back about 16% to the current range around $4,700. That kind of correction inside a structural bull market has historically been a buying opportunity, not a warning sign. None of these drivers have gone away. Let's talk about the actual returns, because this is where most gold content either oversells or undersells the asset. From 1971 to 2024, that's over 50 years, the S&P 500 delivered average annual returns of around 10.7%. Gold delivered 7.9% per year over the same period. So stocks win over the very long term. That's the honest truth, and it matters. But here is what that number hides. Gold does not perform like stocks. It performs differently from stocks, and that is precisely its value. In 2022, when the S&P 500 dropped 18%, gold held its value and actually rose slightly. In 2008, when the stock market collapsed 38%, gold gained 5%. During high inflation periods, the 1970s, 2020 to 2022, and now again in 2025 and 2026, gold dramatically outperforms equities. Now let's look at the recent numbers. If you put $10,000 into gold in 2016, when it was $1,250 an ounce, you would now hold approximately 8 ounces. At today's price of around $4,700, that position is worth $37,600, a gain of 276% in 10 years. The S&P 500 over the same period, with dividends reinvested, returned approximately 230%. Over the last decade, gold actually beat the index. That has surprised a lot of people, and it's the reason institutional investors are paying attention. But, and this is critical, past performance in a specific decade does not predict the next decade. The question is not, what has gold done? The question is, what conditions will drive gold going forward, and are those conditions in place? Gold wins in chaos. Stocks win in calm. Here's the proof. Data-driven, balanced, no agenda. Let's lay out both sides clearly, because both are worth understanding. The bull case for gold. Why the optimists think it goes higher. JP Morgan forecasts gold reaching $5,000 to $5,055 by Q4 2026, with $6,000 to $6,300 a possibility by year-end. Goldman Sachs has a price target of $5,400. Central bank demand remains elevated at around 585 tons per quarter. Inflation is sticky and above target. The Fed is reluctant to cut rates fast. Real wages are negative. The dollar faces structural weakness. And critically, physical buying did not slow down when prices dropped. In Q1 2026, bar and coin demand rose 42% to 474 tons, the second highest quarterly total ever recorded. When retail buyers step in harder on a dip, it signals a market with genuine underlying demand, not speculative froth. The bear case, why the skeptics say, be careful. Gold has already run 41% in the past year. It is not cheap. If geopolitical tensions ease, if the Iran conflict de-escalates, if the dollar rebounds, gold could pull back further from current levels. Some analysts warn of a potential drop to $4,000 if certain key support levels break. More broadly, if the Fed manages to bring inflation down without a recession, and if stocks continue their AI-driven earnings growth, capital will flow back into equities and out of gold. Gold does not pay a dividend. It does not compound. It just sits there. In a strong bull market for equities, it tends to underperform. So who is right? Honestly, we don't know. Nobody does. And anyone who tells you they do is selling something. What we do know is this. The structural case for gold is stronger right now than it has been at almost any point in the last 2 decades. That does not mean the price cannot fall. It means the reasons to own some gold are real and rational, not just emotional. Here is the practical answer, the framework that actually helps you decide. Rule 1. Gold is not a replacement for your investment portfolio. It is a component of it. Morningstar and most serious financial planners recommend no more than 5 to 15% of your total portfolio in gold. Not 50%, not 30%, 5 to 15. Gold is a hedge, a shock absorber, not your primary wealth-building vehicle. Rule 2. If you have zero gold exposure right now, a small allocation makes rational sense in this environment. Inflation at 3.8%, negative real wages, geopolitical uncertainty. These are exactly the conditions under which a 5 to 10% gold allocation in a diversified portfolio has historically reduced volatility and protected purchasing power. Rule 3. How you own gold matters as much as whether you own it. There are 4 main ways to own gold in 2026. Physical gold, bars and coins, gives you real ownership but comes with storage costs and security risks. Gold ETFs, like SPDR Gold Shares or iShares Gold Trust, give you price exposure without the storage problem, with very low fees, and you can buy and sell instantly like any stock. Gold IRAs let you hold physical gold inside a tax-advantaged retirement account. And gold mining stocks give you leveraged exposure to the gold price. They tend to rise faster than gold when gold goes up and fall harder when it drops. For most viewers, gold ETFs are the simplest, cheapest, most practical way to add gold exposure to a portfolio right now. Rule 4. Dollar cost average. Don't try to time the entry. Gold is sitting around $4,700 today, down 16% from the January all-time high. Is this the bottom? Nobody knows. What you can do is commit a fixed amount, say $100 or $200 per month, into a gold ETF over the next 12 months. You stop trying to pick the perfect price. You build the position gradually, and you lower your average costs through any further dips. Is it too late to buy gold at $4,700? The structural case for gold being higher by end of 2026 than it is today is supported by JP Morgan, Goldman Sachs, and the World Gold Council data. What is not rational is putting 30% of your portfolio into gold because you saw the price run and felt like you were missing out. So let's bring this together. Gold hit $5,589 in January, an all-time high. It has pulled back to around $4,700 today. The structural drivers, inflation, central bank buying, dollar weakness, geopolitical risk, are still in place. JP Morgan forecasts $5,000 to $6,300 by year-end. Goldman Sachs says $5,400. Gold has historically averaged 7.9% annually. It does not compound. It does not pay dividends, but it protects. It holds value when everything else is shaking. And right now, a lot of things are shaking. The smart move for most people, a 5 to 10% allocation built gradually through a gold ETF, not all in on gold, not zero gold, somewhere rational in between. If this video gave you clarity on one of the most talked about assets of 2026, hit that subscribe button right now. Every week on First Million Club, we break down exactly these kinds of real money decisions with real data. No sponsored fluff, no hype, just the stuff that actually helps you build wealth. And next week, we are going deep on a question that ties directly into everything we covered today. Is a recession coming in 2026? And what should you do with your money right now? Because JP Morgan just put a 35% probability on a US recession, and the answer changes everything about how you position your portfolio. Don't miss it.